We'd be surprised to see long rates continue to move out because of the weakness that we see evolving in the economy, and because inflation's coming down, and because it could be negative, which I think would shock a lot of people.
In today's video, ARK CIO, Cathie Wood, weighs in on inventory pileups, liability-driven investing, commodity prices, and why she believes that the Fed is making a mistake as they base policy on lagging economic indicators. Wood discusses fiscal policy, monetary policy, market signals, economic indicators, and innovation.
Market indicators. S&P was up nicely in June. And so a lot of that, as we've seen, has been focused on the mega tech category, what people are calling the Magnificent Seven now. And some of them will be prime beneficiaries of this excitement about, and we believe the excitement is real and justified about artificial intelligence. But we think that there are other areas of the market besides the Magnificent Seven that will also benefit, and I think our strategies, or some of our strategies, were a testimony to that in the first half of the year. You know, interestingly, in our broadest strategy, we have 25% in healthcare and an overweighting relative to the broad-based indices like the QQQs, or the NASDAQ 100 as they are called. So we're much more heavily weighted to small and mid-cap, and to be able to have outperformed the NASDAQ 100 in any of our strategies is testimony, we think, to the return of active management. There are investors out there who do not religiously depend on the broad-based indices, but are doing their homework and are saying and asking the question, who is really going to benefit from this massive shift towards artificial intelligence, which is gaining so much momentum because AI training costs are dropping 70% per year. And they're coming up with good answers, we would say. This is what we do all the time, and it's nice to have the company again, if I might say. Long-term interest rates, they moved up from 364 today, 405. Interesting, we're getting a good test here. In March, the 10-year Treasury bond yield peaked around 4.8 to 410. Today it's 405. In October before that, it had a peak at 4.3. So lower highs, we are having a little bit of a test here. And we'd be surprised to see long rates continue to move out because of the weakness that we see evolving in the economy, and because inflation's coming down, and because it could be negative, which I think would shock a lot of people. I was around, did a roadshow in Europe last week, and I asked the question, how many of you here are hearing forecasters talk about deflation? Nobody. Maybe one hand went up, and I said, I think you heard us talking about that. So no one's talking about it, and our confidence is increasing that it will happen, that it won't be all bad. Innovation is deflationary. I just told you AI training costs are dropping 70% per year. That's going to seep into many, many other costs and cause unit growth to accelerate. The Bloomberg Commodity Price Index, it moved up 3% in the month of June, but is still in a downtrend. Should have mentioned the yield curve is still inverted. It got more inverted last month. It got to almost 110 basis points, which is The inversion it reached right before the regional bank crisis. It's come off that a bit here, but we wouldn't be surprised to see if it signaling, more crises, whether they're in the commercial real estate market or in the private equity market in a way that we don't understand right now. Bitcoin, sort of the harbinger for crypto, up 10%, good month. And of course, there is the speculation about a potential approval of a Bitcoin ETF. That got people excited. But the other thing we'd like to reiterate is we saw Bitcoin take off from 19,000 to 30,000 when the regional bank crisis was in full force in March, April. And that told us that Bitcoin is a flight to safety currency. It's a hedge against inflation. It's a hedge against deflation. Deflation presents counterparty risks that do not exist in the world of Bitcoin. And we think innovation broadly is going to become a flight to safety category. We think most investors are very short innovation. They may think they have it covered with the Magnificent Seven, as they're being called now. But we do not think they do. In fact, we think there's going to be some disruption to the Magnificent Seven. ChatGPT as a real risk to search and Google's entire model. And there are other risks in what used to be called FANGs, or now the Magnificent Seven, some of which is even competition for the AI chip world. We think that autos have been a great case in point here. The shift towards electric is happening so much more quickly than I think the auto industry first expected and auto analysts expected. That many investors are on guard now, thinking, okay, innovation, I'm going to take it more seriously. And we think that AI is going to turbocharge the speed at which these shifts take place. And so let's just talk about AI a bit. We think there's going to be a lot of commoditization coming out of AI. As you listened to Frank Downing and Will Summerlin on our last In the Know, foundation models could be commoditized. And commoditization is great for companies who harness the AI that is being commoditized to increase their productivity, increase their efficiency, and lower their unit labor costs. So that's great. That could be a boon to the entire economy. But the companies who will really benefit disproportionately are going to be those with visionary leaders, broad-based distribution, and after those two, most importantly, proprietary data that no one else has. And so that's what we spend our time focused on as we are thinking about AI. We think this move into the megatechs around AI has been more knee-jerk, and it will sort itself out as more and more people do the research. So with that, I'll close by saying, innovation solves problems. We've said that since the beginning of COVID. That's when I started doing these In the Know videos. And I believe with the margin pressures that corporations are going to face, they're going to have even more problems moving forward. So innovation, AI, they're certainly going to make use of it. Innovation, as we saw with Bitcoin around regional bank crisis, is a flight to safety. And one of the flights to safety that investors must consider is the traditional world order being disrupted magnificently by the 5 major innovation platforms around which we have centered our research: multi-omic sequencing, robotics, energy storage, artificial intelligence, and blockchain technology. And the convergence between and among those technologies is going to cause super exponential growth for some, but creative destruction for others. And so we believe in the next 5 to 10 years that investors who are short true innovation, truly disruptive innovation, are going to start moving more and more into that space, allocating capital to its highest and best use.